Right. Today we said we will talk about capital adequacy. Before that, we look into how the banking system run now. Assume so in economics, we would always come up with lots of hypothetical incidents. Now this one, assume there is a country which has only one bank. Okay, so there is a country with only one bank. And this bank is governed by a central bank. Right. One person, there is only, let's say, the money supply of the country is 10,000. One person got this 10,000. He deposited this 10,000 in the bank. Central bank has set SRR, Statutory Reserve Ratio, which is 10%. What does it mean? When a bank receives a deposit, it has to maintain 10% out of that as a reserve, which they cannot lend out. Balance they can lend out. So they lend out the balance, that is 9,000. How do you lend out? Someone need money to buy an asset. So the asset seller now gets 9,000. This seller has no other option. There is only one bank. He comes to the bank and deposit this 9,000. This time, bank keeps 10% of 9,000, which is 900. And the balance, the bank lend out. This time, another person wants to buy a car. Existing car owner sell at 8,100 and deposit the same in the bank. And the process continues. Let's see what happened. Okay. Now, if I drag this down, and maybe I'll stop after about 150 transactions. So the process continues. Okay, now what? Okay, I'll stop here. Right, by now we have reached the value in zeros, and I'm going to aggregate that. What has happened? The total initial amount of money deposited in the banking system is 10,000. I hope you can remember. And bank kept 10% out of that balance lent out. Now, what is the current situation? After 150 odd transactions taking place, bank has lent out 90,000. In the deposits, bank has 10,000. The maximum an individual can deposit is 10,000. That is within the banking system. And the bank has created 100,000. If you round up, 100,000 assets. Okay, so this is called money creation. And the system is secured because the highest deposit, 10,000, is within the bank. So at any moment, anyone can withdraw the highest amount given. Okay, so this is how the banks run. When someone deposit, bank will not give the same amount outside. Bank has to keep a reserve. That is known as statutory reserve, because this amount is decided by not the bank, but by the regulator. From time to time, the regulator or the government change this percentage. Here in our example, the percentage is 10%. What will happen if the government change it to 5% instead? Let's see if we can work it out. Okay. Now, okay, in Sri Lanka, the government reduced statutory reserve, Means what? When you reduce the statutory reserve, okay, something went down. Okay, when you reduce the statutory reserve, you can increase the money supply. Money creation, you can increase. Okay. Now it's 5%. Okay. So you can change the whole formula. And you can increase money creation by reducing the statutory reserve. And when you want, you can, okay, there's something wrong with my Excel sheet. Okay. Now this is the process banks are doing. In a bank, as long as you perform statutory reserve, the banking system can honor even the highest deposit. The 10,000 is in reserves. But what is bank run? Can someone tell me what do you mean by bank run? Yes. What is meant by bank run? Sudden rush of withdrawal of deposits. Yes. So that is bank run. Now, remember, in English, the term run is used with different meaning. For bank, in a sudden withdrawal, where everyone won't withdraw money, what will happen? The bank will find it can't honor all the deposits at once. Right? Now, what will happen on such situation? Whole system will collapse. We'll run through few minutes on bank run, then we'll come to our session capital adequacy. So once again, I'll show you this cartoon to describe about bank run.
Wrong institutions, and for a lot of people, nothing feels more certain than a big, comforting pile of cold, hard cash. However, problems start to arise when a lot of people have that same idea at once. This raises the question, can a bank literally run out of cash if everyone withdraws their money at the same time? And while this may seem like a silly question, the answer is actually a resounding.
We had another serious recession. In these two incidents, there were panics. People want to withdraw money quickly from banks, and banks
crash of 2008, a so-called bank panic begins. During those panics, customers of a commercial bank believe that the bank may close and lose their money as a result. This then becomes a self-fulfilling prophecy, as depositors in a mass withdrawal of their savings, leading to a so-called run on the bank. The vicious cycle continues. Banks lose financial liquidity, savers pull out their deposits. News of this reduces confidence in the bank's stability, and even more savers pull out their deposits as a result. The end result is typically the bank entering a total nosedive. Eventually, the bank becomes totally insolvent and their cash reserves run dry. They end up imposing restrictions on withdrawals, and at that point, the jig is essentially up. You're probably wondering, how on earth does this happen? The two main priorities of a commercial bank are to handle deposits and withdrawals from customers. So shouldn't there be safeguards for this kind of thing? Well, the problem with bank runs is that they're pretty much tailored to the advantage of vulnerabilities inherent in the system. There are regulations on how much physical cash your local bank can keep on its premises, for both their expected daily use of said cash and security reasons. In other words, if a bank's vault is carrying way more cash than it needs on average in a day, and that bank is robbed, that's an extremely expensive robbery right there. The Federal Reserve also imposes limits on the amount of in-house cash a bank can carry. And even this cash isn't all entirely devoted to customer savings withdrawals. This is called fractional reserve banking, as each bank only keeps a fraction of its overall cash reserves for daily use. Banks also need this cash to provide money for small in-house loans, as well as for investment projects. When the bank's customer base is pulling out money like crazy, they need to siphon extra cash from other areas in order to keep up with withdrawal demand. This is known as increasing their cash position. In order to increase their cash position fast so they can keep up with demand, banks in the process of a bank run will often sell off their assets at institutions even further into the hole. While one might think it would be easy to nip a bank run in the bud by quelling the fears of the consumer base and assuring them that a panicked withdrawal will only worsen the situation, talking sense into the public is often easier said than done. The lead up.
Okay, so theoretically, you can talk to the people and say, if everyone won't withdraw money, the whole banking system will collapse. No, that's not the way human beings behave. Human behavior is a herd mentality. Man is a social animal. We are not taking decisions on our own. No one. We take decisions like buffaloes. When the herd do something, every buffalo follows the same pattern. Okay. Now, these days, when Colombo Stock Exchange started to go up, everybody wants to buy shares. And when we sense a quick selling, everyone wants to sell and get out, and the markets crash. Throughout the world, the same. That's how human beings behave. So even in a bank run, there is no point of talking rational. Man is emotional on such.
Up to a bank run can almost feel like a Mexican standoff. Just like nobody in a standoff situation wants to be the first to put down their gun, customers fear being the last one to exit and losing their hard-earned savings if the bank does eventually fail. The cruel irony is that fear that a bank will fail is often one of the greatest contributors to its failure. Currently, during today's times of economic instability, there have been whispers of restricted cash withdrawals on savings in some United States and European banks. Bank runs are almost always at least a slight risk during times of panic. Right now, we're seeing a microcosm of the same psychology that drives bank runs in toilet paper buyouts. You can apply the exact same
Yes, you have seen that. When we got to know the government is going to impose curfew, and there is something called pandemic, and that is COVID. What happened? Supermarkets, the racks started to be emptied immediately. People purchase things as if there won't be no more sugar production, no more rice production, and no more toilet paper production throughout the world. Don't blame Sri Lankans. This is how Americans behaved. This is how Italians behaved. Emptied the racks in stock market, in markets, supermarkets. People purchased and hoarded a lot of items. That's human behavior. The same when it comes to bank run. When you come to know, okay, the bank is in a financial difficult situation, they will not be able to honor my request to withdraw money. You want money now than late, and everybody wants that.
Formula. People fear toilet paper shortages and therefore buy more toilet paper. People buying more toilet paper fans the flames of shortage fears, and the panic buying continues.
Think about our own human behavior within, say, last 5-6 months. All of a sudden, Pearl Express, there was a ship issue. Immediately, everyone wanted to buy what? Salt. Nobody wants this much of salt. People purchase salt to such an extent that they can live maybe 1 year without going to shop to buy salt. You won't hoard that much. Then think about oil. All of a sudden there was a union members statement. There won't be no more oil in Sri Lanka. Amazing. Every vehicle want to get full tank from the shed. But even now, there is no such shortage. That's how we behave. That's how we think. I want to protect myself. I don't care about others. As long as that's the way we behave, bank runs and other shopping shortages will take place.
Leading to real shortages. It's an extremely basic pattern that feels almost engraved into human society. Let's take a look at a few more historical bank runs to see if the pattern holds true. The period of...
Okay. Now remember, bank run will be there as long as banks are there. We can move into nice technologies, ATM machines, online, whatever it is. Today, we don't have much physical cash in our hand, but still, bank runs take place. Okay, we'll look at some historical
Time that
improvement.
brought bank runs into the national conversation was the Great Depression of the 1930s. It all started with the stock market crash of Thursday, October 24th, 1929, which reached its grim peak on October 28th, also known as Black Tuesday. The United States had just experienced the Roaring Twenties, one of the greatest periods of economic prosperity in history. But that was all about to come crashing down. The market and the general public had been massively overconfident due to the prior trend of market growth, overpricing the stock and artificially inflating the market as a result.
Okay, overpricing. Colombo Stock Exchange, if you name certain companies like Expo, massively, heavily overpriced. Look at vehicle market in Sri Lanka, overpriced. And we have talked about bubbles, all bubbles burst.
This led to what economists called the asset bubble. And the thing about bubbles is no matter how attractive they seem or for how long, they always burst. And that's exactly what happened. Bank credit also rose rapidly, and they were handing out loans like candy. The public weren't afraid of debt because the market had been so stable for so long. The general public were buying on margin, which means, in a very simplified sense, they were making down payments on stock with money borrowed from the bank.
We talked about margin trading. Margin trading means mortgaging your existing stock portfolio and giving further loans only to buy shares. That mechanism will enable people more ability to buy. That will enable people to buy more shares. And what will happen? When the demand is high, price goes up. And that creates a bubble.
Meanwhile, industrial and agricultural overproduction was hurting share prices, and a sudden 1% interest hike from the Federal Reserve Bank of New York added to the pile of factors in this economic chemical reaction. The resulting explosion effectively collapsed the entire U.S. economy, kicking economic growth to the curb and sending the gross domestic profit into freefall. So this brings us back full circle to bank runs. The public were terrified by the sudden shock of the economy that had been doing so well abruptly disintegrating around them. As a result, they wanted the comfort of having cold hard cash in their hands and under their mattresses. Americans flocked to banks and withdrew cash en masse, exacerbating what was already a complete economic dumpster fire. Financial newspapers at the time were releasing headlines like "Huge selling wave creates near panic as stocks collapse," and "Prices of stocks crash in heavy liquidation."
Okay, we are proud of high literacy ratio. What do you mean by literacy? I am able to read and understand something. But the problem is who write that? With what intention? You must be very careful. Newspapers, media, they always love to carry negative information. Think about the Facebook. How many negative posts immediately shared? But if there's a post like, okay, Sri Lankan economy's GDP is growing positively at this percentage, no one want to share that. But assume you put a post, Sri Lankan GDP goes to negative and there'll be this much of food shortage very soon. Sri Lanka will be like tribes living in those old days. We will be deprived out of these items, including underwear. So, my God, everyone want to share it. That's human behavior.
Fueling further panic, the American public lost faith in the banking system, pulling out their funds and forcing the banks to sell off their assets in order to keep up with demand. It was a textbook series of bank runs, leading to bank failures and an inability to invest in businesses that led to widespread economic stagnation across the nation. Bank runs are never the sole cause of an economic collapse, but they're almost always a component of economic downturn. By necessity, there's something that occurs after a period of economic instability has already begun, and then goes on to make the whole situation even worse. Which brings us to a more recent example of economic catastrophe, the 2008 stock market crash. Unless you're a keen economics enthusiast, or you've seen or read The Big Short, you probably need a quick refresher on what exactly happened there. Dubbed the worst financial crisis since the Great Depression, the stock market crash was caused by the huge and dangerously unstable subprime mortgage market, wherein millions of people with obscenely terrible credit were given mortgages that lenders often knew they couldn't ever really pay back, creating a housing bubble. You may have gathered by this point that there are major similarities in pretty much all the economic disasters of the 20th and 21st centuries, and you wouldn't be wrong. Just like we said earlier, economics and human psychology are intrinsically tied together and tend to run in endless repeating cycles. Much like the Great Depression, the devastating economic collapse precipitated by the 2008 stock market crash set fire to the tinderbox of an already financially paranoid public. The collapse of the Lehman Brothers Bank suddenly reminded the world that the financial institutions around them weren't infallible forces of nature. Banks could go down, and if they went down, they could take all of your savings with it. As a result, the bank runs began, and people across the globe started once again making mass withdrawals. Banks like the Northern Rock Bank in the UK were
now those days you had to go to physical to the bank, now in front of ATM machines.
devastated by the sudden influx of terrified consumers who wanted their money where they could see it, soon being pushed into insolvency by people who just didn't trust the system anymore. And honestly, who could blame them? Bank runs are the financial expression of pure public panic, occurring only in times when customers simply don't trust banks to keep their money safe. By now, we imagine you're feeling probably a little paranoid yourself. Is it possible that in the next few weeks, the banks we've been entrusting all our savings to will just collapse under the weight of their customers' worst fears? Well, thankfully, it's not really that simple. After the devastating effects of two different rounds of bank runs, central banks like the Federal Reserve have put in protections and regulations to keep banking institutions and their customers from falling victim to bank runs. The Fed ensures that bank consumers are given deposit insurance, the purpose of which is making sure that even if a bank doesn't...
We talked about deposit insurance. When we discussed about insurance, we talked about Sri Lanka deposit insurance scheme.
...indeed go under, customers are ensured that they'll get their savings back. This isn't a new development either. The Federal Deposit Insurance Corporation, or FDIC, was first formed in 1933 as a response to the ravages of the Great Depression. In fact, it was the existence of this deposit insurance scheme that prevented the bank runs during the 2008 financial crisis from being a heck of a lot worse. In the event of a bank failure, the FDIC can help transition the customer savings account into a different bank, or even, in worst-case scenarios, auction off the assets of the collapsed bank as collateral to pay off the customers for their lost savings. The banks themselves also have some methods for counteracting the potentially devastating effects of a bank run. One method is slowing down the process by artificially lengthening withdrawal queues in order to hold back the tide and cling on to some stability. The bank may also borrow money in order to put themselves in a better cash position rather than immediately resorting to siphoning out investment in loans.
Okay, so banks, they themselves will try simple tactics. When there is a queue to withdraw money, you can slow down the process. And that will make people, okay, it's better I come tomorrow. Like the vaccine queues, there will be queues to withdraw money. The longer the queue, you think, okay, I will not withdraw today because the queue is too long. That simply changes your thinking process.
Money or selling off assets at a reduced price. They can receive a loan from other commercial banks or from the Federal Reserve in these kinds of exceptional circumstances. Another innovative method commercial banks use to protect the threat of bank runs is the introduction of term deposits. These are a particular kind of savings account where the customer forgoes their right to withdraw their deposit at any time in exchange for holdings at a fixed interest rate. This means that the bank ultimately retains unilateral control over when the deposit can be removed, up until the agreed upon term date, making bank runs for these kinds of deposits effectively impossible. These days, while bank runs will continue to be a risk for as long as human beings are panicky and erratic, measures put in place to mitigate them mean they won't be nearly as devastating as prior instances. Banks are more familiar with the threat, and insurance measures are put in place by the FDIC to ensure that the average Joe won't be left penniless as a result of other customers' fear and impulsivity. But in any situation where mob mentality causes problems, it's important to be part of the change. Don't panic and pull your money out at the slightest sign of instability, because if you do, you're just another part of the cycle. Thanks for watching this episode of the Infograph.
Okay, so that's on bank run. Means what? Banks have to remain in business and do business. But unfortunately, unlike other businesses, your customer can quickly, within one day, ensure you are no more in business. One simple word of mouth against you will fail you. Okay, so there must be enough capital to cushion your ability to meet shocks in the market. we'll once again look into a nice formula. Very basic accounting formula is A equals C plus L. That is the very simple accounting formula. Can someone tell me what do you mean by this A? What is A stand for? C and L. Can someone tell me A equals C plus L? What do you mean by that? Quickly. The basic accounting formula, assets is equal to capital plus liabilities. Very good. Unlike any other company, in a bank, asset, if we give 100, the capital is very small amount and liabilities are very big. Why? Because unlike any other business, general public will come and deposit with us because we can buy deposits. No other company can accept deposits from general public. When our asset base grows, let's say it double, but if our capital remains the same, what will happen? General public have to face the consequences when our decisions are wrong, right? Company or our bank grows to such an extent where our assets grow fast, still our capital is the same. And now what has happened? More and more people come and deposit with us. What does it mean? Asset of a bank, say the loans we give away are our assets. What is our liability? The deposit from general public is our liability. Capital is almost like any other business, the owner's money. When the business grows, what does it mean? We give more and more loan. Out of what? Depositors' money. Right. Now what will happen? Assets are growing, means our loan base is growing and our deposit base is growing, but our capital is not growing. Means what? The owners of the business can, without putting any extra money, can lend out of others' money. The more you lend out at a very higher interest rate, the more profitable your business becomes and your owner will be extremely happy. He can take a massive dividend out. But unfortunately, growing business means what? You are giving more and more loans. Means what? Some of these loans will not be able to be recovered. And you understand there are risky businesses. Those loan takers are ready to pay very high interest. Now what is happening? There is more high possibility of a great majority of them not being able to pay back. But I have recovered my amount. My initial capital I have already recovered. Now depositors will be burnt live. That happened in 2008 mortgage crisis. Banks gave loans to many people who really cannot pay housing loans, but you gave away loans. These people could not pay back. You got hold of the assets and looked at the second-hand market to sell it. And the more assets are there to sell, even the existing good payers preferred not to sell. Now the asset market is coming down. Property price comes down. Now what is happening? Nobody wants to buy property. And one by one, banks started to collapse. That was shown in the cartoon. Lehman Brothers, very old bank. Northern Rock, banks started to collapse one after the other. When one bank collapsed, depositors of another bank think, okay, next will be my target. The depositors of Lehman Brothers are suffering. If I don't withdraw my money now, tomorrow my bank will collapse and I'll have hard time. I want to avoid that. I want to withdraw money and everyone wants to withdraw money. That is the worst situation. Now, if a regulator ensures proportionately when your assets are growing, your capital liability must grow. Okay, for 100, you have to keep 10. Means what? 90. You can accept deposits only up to 90. Balance, you have to put your money. When the asset goes to 200, 10% must be capital. Okay. Now we have to increase your capital, and balance you can take from deposits. This 100 and 900. What does it mean? If a bank collapses, owners will also suffer. Initially, it's owners who have to look into that, not the depositor. With that intention, we look into capital adequacy. Means what? Keep enough capital to meet the requirement of assets. We'll look into that. Okay. So we did capital adequacy ratio, CAR, is a measurement of banks' available capital expressed as a percentage of a bank's risk-weighted credit exposure. Okay, risk-weighted assets. So we call them risk-weighted assets. Means what? Okay, now tell me, what are the assets of a bank? What are the assets of a bank? Can someone tell me? Loans, what else? Advances, right? What else? Reserves, very good. So reserves put into, yeah, investment is asset. Reserves is in the capital side. Okay, so mostly the loan advances are falling into assets. Then some of your investments, and you keep a little bit in cash, that's an asset. You own cash. You keep a little bit in treasury bills, that's asset. That's your investment side. Rest, your capital and deposits. Okay, so we are looking at risk-weighted assets. You said your loans are your assets. Now my question is, are all loans equal risk-wise? I'll give you three loans. All loans, I'm going to talk about three loans. A loan for the, let's assume there is no pandemic, okay, in this one, no pandemic, and the economy is smoothly running. So number one, there is a person who has taken a loan 5 million as a leasing for a school van. Number two, there is a person who has taken 5 million as a loan against his fixed deposits. That's B. C, a young person without any mortgage has taken a loan to develop a software, 5 million. Value-wise, all these three are equal, 5 million. What is the highest risk? What is the highest risk advance I have given? C. Least risk, BOA. Yeah, highest risk is C. Least risk is B. Why? Because it's against your own fixed deposit. You have given the loan. Right, means what? Now you clearly understand your asset called loan can be risk weighted. This is why we are looking into capital adequacy. Your assets can be risk weighted. The capital adequacy ratio, also known as risk-weighted asset ratio, is used to protect depositors and promote the stability and efficiency of financial system around the world. If bank gives all C-class loans, bank is having a problem. If bank gives all A-class loan, once again, bank will have a problem. So you have to match different risk appetites. There is a city called Basel in Switzerland where all the bankers get together and decide on bank certain regulatory requirements. Basel Committee on Banking Supervision is a committee of banking supervisory authorities that was established by central bank governors of the group of 10 countries in 1974. Okay, central bank governors, they get together and take decisions, especially in year 2008, the three alchemists, what we call them, that's how we call them. I think I have talked about alchemists when we talk about gold. Alchemist is a term used for bankers today. So in 2008 financial crisis, the governor of European Union, EU, the governor of England, banking system, and the chairman of Federal Reserves, Ben Bernanke, they got together and took collective decisions. Right? When the economies are connected, the banks have to take connected decisions. The committee expands its membership 2009 and 2014. Right now, this is the banking committee. It provides a forum for regular cooperation on banking supervisory matters. Okay, read it. Its objective is to enhance the understanding of key supervisory issues and improve the quality of banking supervision worldwide. The committee frames guidelines and standards in different areas. Some of the better known among them are international standard for capital adequacy. That's our topic today. The core principles of effective banking supervision and the concordant on cross-border banking supervision. That's where Basel is. The committee secretariat is located at the Bank for International Settlements in Basel, Switzerland. The Bank for International Settlement hosts and supports a number of international institutions engaged in standard settings and financial stability, one of which is BCBs. Two types of capitals are measured. Okay, now your capital can be categorized into two types, Tier 1 and Tier 2. We call that core capital and supplementary capital. Core capital means, okay, that's described here, which can absorb losses without a bank being required to cease trading. Okay, so bank may make loss, but still you can run the business with your Tier 1 capital. Tier 2 capital, which can absorb losses in the event of winding up. Okay. Second one, you are no more in a position to run the business, you want to liquidate, wind up. On such, you want to ensure lesser degree of responsibility for depositors. To that, Tier 2 capital affects you. Calculating capital adequacy ratio. The capital adequacy ratio is calculated by dividing bank's capital by its risk-weighted assets. So we have two tiers, Tier 1 capital adequacy ratio, Tier 2 capital adequacy ratio. If you aggregate that and divide it by risk-weighted assets, we call it capital adequacy ratio. Tier 1. Okay. First read it. So Tier 1 capital or core capital consists of equity capital. Means what? Your equity, your ownership amount. That is ordinary share, intangible assets, and audited revenue reserves. Okay, we look into the components of Tier 1 capital. Tier 1 capital is used to absorb losses and does not require a bank to cease operation. We said that earlier. Core capital or Tier 1 capital will ensure the bank can make losses, but still the bank is in business. Tier 1 capital is the capital that is permanently and easily available to cushion losses suffered by a bank without it being required to stop operating. Okay, so core capital is permanent capital. That's there until business is liquidated. That's what your shares is. If you have purchased shares of a bank, means what? You have contributed to the Tier 1 capital. And until the bank stops its business activity, your capital will be there. A good example of a bank's Tier 1 capital is its ordinary share capital. Yes, that's what you buy as a share trader. You call it components of Tier 1 capital, elements of Tier 1 capital or core capital. Number one, paid up, authorized ordinary shares. Number two, statutory reserves. At the very beginning, with the Excel sheet example, I showed you what you mean by statutory reserves. Other disclosed free reserves. Then non-cumulative, non-preferential, non-cumulative, non-redeemable preference shares. Then then there must be, let's say, profit or loss published, profit or loss unpublished. So these are the elements of Tier 1 capital. Tier 2 capital. Tier 2 capital comprises unaudited retained earnings, unaudited reserves, and general loss reserves. This capital absorbs losses in the event of a company winding up or liquidating. Tier 2 capital is one of that cushion losses in case the bank is winding up. Tier 1 capital or core capital, we said that is important to run the business. When the bank is making losses without stopping, without ceasing the bank activities to absorb losses, you use Tier 1 capital. Tier 2 capital, when the bank is winding up, then a lesser degree to the depositors. Your responsibilities transit at a lesser degree. To absorb that, you need Tier 2 capital. It is used to absorb losses if a bank loses all its Tier 1 capital. Tier 2 capital comes to absorb losses only if all the Tier 1 capital already overspilled. Okay, so Tier 2 capital, undisclosed reserves, subordinated debt, means what? Let's say debentures, hybrid debt instruments, means what? Cumulative redeemable preference shares, general provisions, then revaluation reserves. You have to remember these elements. The two capital tiers are added together and divided by risk-weighted assets to calculate bank's capital adequacy ratio. Risk-weighted assets are calculated by looking at bank's loans, evaluating the risk, and then assigning a weight. This is what we talked with this 5 million example. A, B, C. A is more risky, B is less risky, C is likewise you can categorize. In our case, you said here, C is the lowest risk one. B is lowest risk one. Means what? You categorize that. That is what we are going to do. When measuring credit exposure, adjustments are made to value of assets listed on a lender's balance sheet. Okay. When measuring credit exposure, certain credits highly exposed, risk is extremely high. As I said about giving a loan without mortgage to develop a software, extremely high. And certain, the risk is very less, and you said that. When you give away a loan against fixed deposit, you find its risk is less. And now we are categorizing based on the risk. All of the loans the bank has issued are weighted based on their degree of credit risk. And these degrees, based on that, you can make them 0% risk to 100% risk. Now, risk-weighted assets are used to determine the minimum amount of capital that must be held by banks and other institutions to reduce the risk of insolvency. The capital requirement is based on a risk assessment of each type of bank asset. For example, a loan that is secured by a letter of credit is considered to be riskier and requires more capital than a mortgage loan that is secured with a collateral. If you have given a loan without collateral, definitely that is more riskier than an asset given with the collateral. Sometimes banks and even finance companies give away loans and they call them a nice term, clean loans. Means what? We don't have any asset backed and you give away loans. This is very risky. What is the risk? If the customer fails to pay back, you don't have anything to get hold. Okay. So sometimes you give away loans with PD checks, post-dated checks. And when they don't pay, you believe you can go to courts. But the process is difficult. This is where mortgages comes in handy. Why capital adequacy ratio matters? The reason minimum capital adequacy ratio are critical to make sure that banks have enough cushion to absorb a reasonable amount of losses before they become insolvent and consequently lose depositors' funds. The capital adequacy ratio ensures the efficiency and stability of a nation's financial system by lowering the risk of banks becoming insolvent. Generally, a bank with a high capital adequacy ratio is considered safe and likely to meet its financial obligations. Okay. So there must be minimum capital adequacy ratios that is decided by the Basel. And all the banks throughout the world have to follow that. Means what? We believe if one bank anywhere in the world collapses, that will have negative impact on all the other banks. That is not the case with any other businesses. Now, let's assume in your town, you are having two bakeries competing each other. Okay. Now, these days, with the three-wheelers, they are coming to your doorsteps and selling bread, buns, other things. So there are two competing forces in your village or the area you live. One bakery bankrupt and they close down the business. Is the other bakery owner happy? Yes, extremely happy. Why? I lost my competitor and I'm very happy with that. That is not the way banking and finance sector work. If one bank collapses, the other banks don't like that. The central bank or the regulator wants to ensure financial system stability. Unlike any other, okay, capital adequacy ratio, liability and the asset. When you give away more assets, means what? When you give more and more loans, there is a probability some of these loans will not be recovered. If that loans cannot be recovered, who should bear that? Okay. Your bank is having 500,000. That's the all money you have in your bank. This entire 500,000 is given to one individual. Means what? Extremely risky decision you have taken. And that individual collapses. He can't pay your money 500,000. Now what happened? He has not even given a mortgage. Now what happened? You can't run the business. You don't have money. Okay. Now that's bankrupt. Now the problem is, who share this 500,000? Suppose you have started the business with only 1 rupee and the balance is from the depositors. Okay, means what? You may have already other assets, so you are not worried. You are losing only 1 rupee. Entire balance is lost by your depositors. This is the relationship. Instead, when you give away loan 500,000, you being the owner of the bank, you have to give, let's say, 10,000, 490,000 by depositors. Means what? When the bank collapses, you lose 10,000. You don't like to lose that amount. Okay. So you want to ensure I'm somehow recovering this 500,000. So when you are giving away loan, you are very careful. Then the depositor's money is safe, your money is safe. Suppose you have given away loans, this 500,000 consists of different types of loans and only one loan failed to pay back, and that is 10,000. And your capital is 10,000. Without transferring the liability to depositors, you can bear it. The business can run. So this is what we are looking at, right? Now, when we come to here, unlike any other businesses, if one bank collapses, depositors believe all the other banks are not safe. They want to withdraw money. And one after the other, banks will collapse. That is what I showed at the very beginning. Banks run. When one bank collapses, depositors line up in a queue in front of other banks, and the entire banking system collapses. And it creates repercussions. Everything fails. That happened in year 1929. That is known as Great Depression. Year 2008, something very similar repeated. Okay, so that's what we want to avoid. During the process of winding up, funds belonging to depositors are given a higher priority than banks' capital. So depositors can only lose their savings if a bank registers a loss exceeding the amount of capital it possesses. First, capital. If there is a loss and if the bank cannot run, first, the depositor is safe. First, the capital should absorb the loss. If that is not sufficient, then only it passes to the depositor. Thus, the higher bank's capital adequacy ratio, the higher the degree of protection of depositors' assets. Okay. The more capital you have, the simple losses you can absorb definitely with the capital, and the depositor is very safe. Off-balance sheet agreements such as foreign exchange contracts and guarantees also have credit risks. Such exposures are converted to their credit equivalent figures and then weighted in a similar fashion so that on-balance sheet credit exposures. The off-balance sheet and on-balance sheet credit exposure are then lumped together to obtain total risk-weighted exposure. Okay. Certain items like loans which you give away are in your profit and loss and in your balance sheet. But off-balance sheet agreements, off-balance sheet, now you don't take them to transactions. You have signed some contracts, but that contracts will also make it risky. Such should be also taken into consideration. Then there is something called solvency ratio. That means there must be enough liquidity. Both the capital adequacy ratio and the solvency ratio provide ways to evaluate companies' debt versus its revenue situation. So both is looking at debt and its short-term and long-term outstanding financial obligations. Solvency ratio will 20% indicates an increased likelihood of default. So if you don't keep enough money, there's a chance that you will not be able to pay your loans. That's on solvency side. Analysts often favor solvency ratio for the comprehensive evaluation of company's financial situation because it measures actual cash flow rather than net income. Okay, so solvency ratios. Some analysts actually interested in that because you are not looking into profit and some other imaginary figures, numbers, but actual cash flow. So in liquidity, you will see whether you have enough money. Okay, so you actually measure cash flows rather than net income, not all of which can be really available to a company to meet obligation. The solvency ratio is best employed in comparison with similar firms within the same industry, as certain industries tend to be significantly more debt heavy than others. So when you compare industries, solvency ratios, you check your industry's solvency margins, not other industries. Certain industries, the solvency is different. Say your profit margins, the way you behave, the assets, these are different from companies to industry to industry. So when you compare with your industry. Year 2008, when there was a financial crisis, when banks were falling one after the other, Lehman Brothers fell, then Northern Rock, okay, and there was a bank in France, it fell down. It is said in books that only in 2 countries the banks did not collapse. One is Canada, the other is Israel. In almost all the other countries, banks or finance companies collapsed in year 2008. On such, a cartoonist drew this. A ship is capsized and the rescuer's helicopter announced, "Attention, if you are the ship's captain, its investor or manufacturer, we are here to rescue you." Means what? When government bail out, people felt the depositors are not cared, but the investor, the captain. Okay? So that not be the case. First, you have to rescue the general public. That's where capital adequacy matters. Generally speaking, these rules mean that the greater risk to which the bank is exposed, the greater the amount of capital the bank needs to hold to safeguard its solvency and overall economic stability. Okay. listen and okay, first read it very carefully. The more you give away loans, the more riskier your business becomes. Then we can look at the types of loans you are giving away. Sometimes banks will undertake risky businesses because your profit margin will go up. But it's unfortunately extremely risky business. These days, giving away loans against gold is a risky business. These days, giving away leasing facilities for vehicles at this current market price is a risky business. Okay, but we are doing that. Suppose all of a sudden, from nowhere, this coronavirus disappeared and foreigners, tourists start to visit Sri Lanka. Foreign remittances starts to grow up and the dollar rate comes down, rupee appreciate. Just assume. What will happen? Government will definitely relax these restrictions on imports. So even if government finally have to go to IMF, something similar will happen. Then what will happen? Suppose COVID disappear from planet Earth due to miraculous finding by scientists, what will happen? The gold price will not be the same. It will come down. The safe haven chance of gold will come down. People move into other asset classes. What will happen if you have given loans against these assets, gold and vehicles? At these valuations, we are in trouble. Okay? So that's our business. Not all banks are equal in giving away loans for gold. In 2011, I showed you the figures when we were talking about pawning. Certain banks, out of their loan portfolio, 1/4, 1/3 was on gold. And gold price came down drastically next time. All bubbles burst. So these banks will have to face difficult times. Okay. Now, who will bear these decisions? Decision is taken by the management. Okay, we'll go and give gold at this price. Okay, your asset grows, your loan base goes up. Next, the bubble burst. What next? The Basel III guidelines are based upon three very important aspects, which are named three pillars. So the pillars are minimum capital requirement. That's what we are talking under capital adequacy. Supervisory review process and market discipline. Okay. So Basel is like a house built on three pillars, strong pillars. Just read it. The first pillar deals with maintenance of regulatory capital requirement. You can easily remember .com, COM, credit risk, operational risk, market risk. First pillar is on risk, right? And what are these risks? Okay. You can easily remember .com. Now the first is minimum capital requirement, supervisory review, market discipline, right? Regulatory capital is calculated based on the risk from these credit risk. What is credit risk? When you are giving credit, is your decision right? Okay. Operational risk. Can there be frauds in your company? Market risk. What will happen if the gold price comes down? Okay. Second pillar. Other risks other than the .com, credit operational market, other risks, systemic, concentration, systemic risk, okay, entire system will collapse, concentration, your area, liquidity and legal. So other risks are under secondary pillar. Third pillar, market discipline, disclose. We believe if I disclose a name, let's say when you are attending to school, You are asked to submit an assignment on 25th of August, right? And you fail to submit that report sharp on time. So in your class, there are 100 students and only 3 has not submitted. 3 have not submitted assignments before the deadline. So in the notice board, they put 1, 2, 3. These following members have not submitted assignment on time, and they will be given 0 marks. Disclosed. What is happening to you if you are one of these 3? Shame comes to your mind. Disclose and shame them. Name and shame them. That will discipline you. So that is the third pillar.
Excuse me, sir.
Yeah.
So regarding the credit risk, what is meant by credit risk is that customer becoming default or the decisions taken by the managers.
Customer fails to pay. Why? Because the decision taken by the management is not in proper place. Do you have a credit policy? Is this policy correct? Are you updating on credit policy? Right? So a good customer may all of a sudden be unable to pay, that's something. But credit risk, okay? Do you have a credit policy? Is this policy reviewed from time to time? That's what we are looking under credit risk. Okay, let's see how that is shown. Credit risk. Credit risk in banks. Possibility of loss resulting from borrower's failure to repay or meet contractual obligations. Traditionally, it refers to the risk that a lender may not receive the owed capital and interest. Okay, so when I'm giving away loan, can the customer pay back? That is the credit risk. Okay. Credit, operational, market risk. Operational, purely on your side. Are you managing? Can there be frauds or maybe even fire? That kind of operational area risk. Then the market often fluctuates. Are we safe against that? Okay. Now, the third pillar is on discipline matters. Okay. The third pillar requires the bank activities for the transparent to general public. Now, initially, a lot of finance companies, financial statements were not available to general public. Today, almost all the finance companies are listed companies. Means what? When you are a listed company, your shareholders will see your financials. And these financial statements must be updated on a timely manner. If not, your name will appear in default board of stock exchange. Name and shame you. For this, bank is supposed to release relevant financial data in a timely fashion to the general public. For example, through its web page. This might enable depositors to better evaluate bank condition and diversify their portfolio accordingly. As such, this pillar itself will enhance the role of market discipline. Okay, market discipline means finance companies and banks must publish their financial statements in a timely manner. You have seen in national newspapers, your financial statements are published. What is the understanding? The general public will go through these statements and take decisions, and the decisions will affect you. Market share price will come down. Then the management comes to know something wrong with the way we manage our business. Or depositors give the signal, I'm going to withdraw money. They are slowly withdrawing. That gives a signal. Now you find when you want to go for deposits, you have to pay higher interest rate than others, slightly higher. That gives the signal. Why the signal is coming? Because people read and understand financial statements published by you. Okay, still on market discipline. The bank managers have strong incentive to be involved in risky activities. What is that? When you are a bank manager, you are extremely happy to say, in my area, in my era, we earned highest ever profit. Almost all CEOs love to say that statement. In my era, I made highest ever profit. In my era, the revenue reached highest ever. Means what? I am giving away loans. Anyone can give away loans. What is the difficulty? Recovering that. Okay. So banks strongly incentived to give away loans. Your bonus will go up. Profit, a number. Revenue, your loans. And that is the easiest thing you can do. What is the difficult thing? Okay. There was a time, let's see if I have this information with me. Okay. There was a time a particular microfinance company all of a sudden showed superb performance. Okay. Bimput Lanka, that's a listed finance company. All of a sudden, they made superb performance. Their revenue went up substantially. Profit went up substantially. Right? And NPL ratio was almost touching 0. So you are very happy with the statement. Right? But they could not sustain that. Okay. So it's very easy to show impressive results in banks. You have to give away loans, that's all. But the problem is, are they quality loans? This is mainly due to the bank balance sheet structure and safety nets existence in financial markets. Nevertheless, bank depositors can simply withdraw their funds or ask for higher deposit rates when realizing the bank they are investing is taking excessive risk. Okay. When the depositors understand I'm investing in a very risky bank, I'm depositing in a very risky bank, either they may withdraw money or ask higher interest rate. That gives the signal, okay, we are not managing our business well. One might suspect if this is in fact the case and whether market discipline really exists or not. After all, depositors are under some sort of government guarantee anyway. Now, one thinking, okay, we believe this is how customers behave. I'm asking you this question directly. Do you think that when customers come to your bank to deposit money, they have ever read the financial statements you have published in newspapers? Say yes or no. When your depositors come to deposit money in your bank, yes, what is that? No. No. Now that's the problem. Okay. The problem is, even though we think by publishing our financial statements, people will read and understand it and take decisions, are they in a position to do that, or are they really doing that? Right? Now, these days, we have seen a massive rally in Colombo Stock Exchange to buy Expo, and the share substantially went up. But I doubt whether any of these investors who have invested billions, read them. Right? So that is another question, a drawback. After all, depositors know there is a government guarantee anyway. If I deposit 600,000 or less in a finance company, I don't want to read the annual reports. In fact, there are even implicit insurance schemes like too big to fail. Right? So the known is deposit insurance scheme, and I am guaranteed 600,000. But there's implicit. What is that? Too big to fail. What do you mean by too big to fail? Can anyone tell me something about that? Too big to fail. Several years ago, in your institute, IBSL, there was a paper called Financial Survey Management. Yeah, Financial Survey Management. In this paper, there was a question like this, exam paper. In my words, it's like this. When Pramukha Bank collapsed, government did nothing, or the right authorities did nothing. But when there were symptoms of Ceylon Bank, there were immediate actions taken. Okay, so in 2008, I think there was certain regulatory involvement and intervention with Ceylon Bank. Next year, Ceylon Bank did extremely well and came up with a nice annual report, and The title of the annual report was Case Study. They perfectly came up over all these problems. Now, the question in this paper was, when Pramukha failed, regulators intervened. When Ceylon didn't intervene, when Ceylon immediately intervened, why? Now I'm asking, what do you mean by too big to fail? Means what? When a small bank fails, it has less economic impact to the nation. So the regulators are not interested. Lehman Brothers failed, right? Freddie Mac failed, Northern Rock failed. US government was not much worried. But when they see next, a very big insurance company was about to collapse. When they felt next, after this insurance company, the biggest insurance company of US, after they are collapsing, there will be big banks lined up to collapse. So that was Saturday, Sunday, weekends. Chairman of Federal Reserves and Treasury Secretary all got together, sleepless nights in weekend. Monday morning, they announced 700 billion US dollar package. And the big banks and the insurance company, they could save. Means what? Even in US, when the small banks fail, there were no intervention. Okay, let it happen. When the big banks were about to collapse, they intervened. When big companies collapse, the economic impact is very heavy. So there is implicit, okay, if I have deposited in a very big bank, this bank will not collapse at any cost. If it's going to happen, regulators, government, everyone will intervene and prevent it happening. So we call it too big to fail. Where regulators in the central agencies feel obliged to rescue a troubled bank with fear of financial contagion, why then depositors bother to monitor bank activities under these favorable circumstances? Therefore, making the relevant financial data publicly available in timely fashion will supposedly help investors to better evaluate bank condition. Okay, we are not saying exactly everyone is doing that, but that will enable people to evaluate. It's always better to have information than not having. The right amount of information release is essential. So there is a format. These things must be published. Now I'm asking you to, whenever you come across paper publish advertisements, so on financial statements, full page, half page by your bank, read that. Compare with another bank. Compare with another finance company. What are the must mandatory information? Check into that. Too much information will not give a good result. A timely, balanced amount of information. Okay. Now, credit risk is the risk of debtors non-payment. Okay, so you asked that question earlier. Operational risk. Frauds, information, physical or environmental, like maybe flood, tsunami, fire, that also part of it. Market fluctuations. So I have given you all what you need to know under these risks. So commodity prices go up and down. Okay. Then what is meant by why do you want capital adequacy? If you have enough money, then you can absorb losses instead of passing them to depositors. Capital requirements are necessary to prevent banks expanding beyond their limits. Okay, expanding beyond their limits. I have deposited only 1 rupee and my bank is giving me 100 million as a dividend. My God, if that is the case, I'm extremely happy. And I don't mind if that 1 million is lost. Why? I don't feel it. But that may be all what depositors have. Have you seen after a bank or the finance company collapsed, how much the depositors cry. Some of them suicided. Listen to their stories. They say, this is the whole money I had. And I meant to meet these financial responsibilities out of this money. I wanted to do my heart surgery. And this is all what I have. And I kept in this bank, waiting in my doctor's line for 2 months. But within that time, money gone. A blind person said, this is all what I have to me and my children. Okay. So that's how depositors feel. They are the biggest contributor and the shock absorber. But if you have enough capital, they will shoulder the risk only after your capital risk is over. So capital requirements are necessary to prevent banks expanding beyond their limits. Okay. I am asked to increase my capital if I want to give more loans. And I contribute more capital, then I can go. When I go, I have to put more money. When I put more money, I'm very careful to protect my own money. It is not others' money. I worry about my money. The importance of capital adequacy is indicated by the development of an internationally accepted measure. That's Basel, risk asset clause. So all assets are not equal. So they are risk-weighted assets. That's what we said earlier as well. At the beginning, I asked, what are the asset side, capital and liability side? So assets, your cash, your investments and loans. These are the assets of a bank or a finance company. Then what you have already contributed as ordinary share plus your retained profit is your capital. Loans from general public, loans from other banks, deposit from your customer, and debt securities are your liabilities. You can issue debentures and get money. Right, now these percentages are changing. Tier 2, what is the percentage? Tier 1 percentage. Now you have to have an understanding of that. What is licensed finance companies where asset is less than 100 billion? Tier 1 capital. Now we are in 2021. With effect from 2021 month of July. Tier 1, 8.5. Tier 2 capital, 12.5. Now we look into Colombo Stock Exchange. If possible now, we'll see in different finance companies, what is the amount they are keeping. Normally, central finance is the richest in capital adequacy side. We'll see that. So when you enter the code CFIN, you can easily access to their information. Okay. Now we go to financials. We may go for annual report. Okay, so you are given the amount 8.5, 12. Right, now we'll see whether we can quickly access to their capital adequacy ratios. Will that be quickly available to see? Yeah. Tier 1 capital. What is the expected amount? 8.5. Okay, we'll see that. Expected Tier 1 capital 2021, 8.5. Tier 2 capital, we call it supplementary capital, 12.5. 8, 12. 8.5, 12.5. Now, central finance, the heavyweight in that side. Tier 1 capital, 32%. Total capital, again, 32.8. Okay. So this is capital adequacy wise extremely safe. We'll compare that with another finance company. Let's say we'll take LB. So we'll take another one, let's say PLC. Okay. Now this is what you must be doing. Check and compare. Right. So I'm not saying having the highest capital adequacy is a good thing or the bad thing. Right. So I allow you to look into different thinking patterns. Say some would say that is inefficient, some would say that is extremely good. So look at how different people look into these. Let's see once again, can we easily get into this? Okay, so one thing is sure, definitely all the finance companies and banks are above the minimum requirement. Okay. Okay, so this information are available, right? So I'm leaving you to check into these finance companies. One thing is very sure, in the entire finance industry, central finance, their capital adequacy ratio is very high. Now we'll see whether we can go for a bank, and we'll see without taking much time whether we can look into their capital adequacy ratios. Okay. Now you know that general public, like what we are doing now, can easily access to information. So before depositing, before taking financial related decisions, they can compare. But all the relevant information are there. But my problem is, are we reading? Are we comparing? Okay. Let's see whether I'm able to get it quickly. If not, I'll leave it to you. Okay. All right. Here, this one. Tier 1 capital 13, Tier 2 capital 16. Okay. So well ahead. So that's how banks and finance companies are running. But certain banks, like I showed you, central finance example, they keep an extremely high amount. Right. The harmonization of capital adequacy norms. Yeah. Go ahead. Any question?
Having a high tier 2 capital means they have a high probability of facing risks?
No, that's how they have been managing, right? Now, there is only minimum requirement. You must keep 8.5 and 12.5. That is the minimum requirement, okay? Keeping more than that is a management decision, right? Regulator asks you to keep only that amount. More than that is your own individual decision. Central finance, being a family-owned company, is managing in a different style, right? You can't say it's good or it's bad. What is required, minimum amount. Basel, they keep the guideline. Then from Sri Lankan point of view, we look into our context and we decide our one. And central bank has given that. You have to comply with this. It does not mean you have to maintain 3 times, 4 times. No. But if you maintain more, means what? Whatever the money available to do business, you are not doing business. Right? So when you are keeping more means what? If there are unexpected events taking place, still you are safe. Having more means you are very safe. At the same time, if you keep 100% of your own in capital, means what? You are not using others' money to run business. You are not efficiently managing that. When you are as a bank or the finance company having the ability to get money from general public, if you are not using others' money, then from one way, you are not using your license perfectly well. You are given a license to accept money from others. So you run business by accepting money from others. Right? But there can be different ways of managing a company. Okay. Now, if we compare the dividend payout, okay, PLC, when you earn about 2 rupees earnings per share, 1.25 definitely goes out as dividend. That's one way. Central finance, when you earn 2 rupees, maybe you are paying about 20 cents as a dividend. So you are accumulating enough reserves within you. So you may not need that much from general public. So these are different management styles. I'm not saying one is good, the other is bad. I'm showing you, number one, this is the minimum requirement. Number two, there are companies who keep even very high amount on their own account. Right. Now, when it comes to capital adequacy, throughout the world, it is practiced. So throughout the world, the banking system is safe. Why? When one bank collapses, that will negatively affect to another bank. Harmonization of capital adequacy norms across the world. Strengthen the world banking system. Okay, read it. To ensure that the banking across the globe would be able to withstand any problem. Now, COVID is affecting all of us. Now, having such standard enable us to face it, to provide an equal base for banks in the world to compete. To remove the incentive, a bank may relocate where the rules are relaxed. Okay. For your exam purpose, what are the elements of Tier 1 capital? You can easily remember: paid up ordinary shares, non-cumulative, non-redeemable preference shares, statutory reserves, published retained profits, general and other reserves, unpublished profit and loss. Then off-balance sheet items on Tier 1. Tier 2, what are the elements? Right. Then how do you calculate? So it can be on 0%. Now we are looking at the assets. At the very beginning, I talked about 5 million ABC asset classes. Now we can assign different weights for these classes. There is no risk when you keep money, when you keep your asset in cash, gold, treasury bills and bonds, central bank securities, loans against cash deposits. These assets are zero risk, zero weighted. Okay. Then 10%. OECD, Organization for Economic and Cooperation Development governments, when they guarantee 10%. So there are countries which you can compare and which you can't compare. You can't compare Nigeria with Japan. Japan, Canada, Australia, these OECD countries, they are very stable. In Nigeria, all of a sudden, within a minute, another military leader will become the president. After 6 months, he will be shot down. Another will become the president. And the economic movements change. Okay, one would say, whatever the loans we have already taken, we are not going to pay that. So when there are crazy changes, you can't trust such governments. OECD, you can trust these governments. But still, you keep a weight. When the government guarantee a loan, still there's a risk. 20% risk. Right. Loans guaranteed by non-OECD governments and central banks. Loan guaranteed by OECD incorporated banks. Loans guaranteed by foreign commercial banks for less than 1 year. So likewise, 20%. Then 50% risk weight. Then 100% risk weight. Then we said there are certain items which are not falling into balance sheet. So what are they? Then how do you calculate tier 1 and tier 2? Okay. So with that, we'll end today's session on capital adequacy, right? And we'll look into some financial statements after that. If time permits, we may look into certain questions, right? Input finance. Okay. So the share is trading at 6 rupees. We'll look into, if possible, the annual report in 2015. Okay. So income has gone up by 132%. Right. That's 2015. We'll see next financial statement. Dream it, achieve it. Okay. Income has gone up by 233%. Right. This time 2.2 billion. Last year 672 million. Okay. And if we talked about profit has gone up by 250%. Okay. What was 143 million has gone up to 501 million, half a billion profit. Let's see next financial year. Steadfast. Interest income has gone up by 23%. Now last year 250%. Okay. We'll see profit. Profit after tax has gone up by 2%. Last year profit after tax has gone up by 250%. Okay. Half a billion profit. Okay. Profit still half a billion. Good. Next year, transforming. Revenue has come down by 5%. Profit has come down by 71%. Next year, supply. Okay, this year, no? Yeah. For the better tomorrow. Now, no comparison percentages. Okay, no comparison percentages, and profit after tax half a billion has become negative 1/3 billion. Negative. Now comes another financial year. Golden harvest. Okay, no percentage comparison. No percentage comparison has come down. Okay, revenue has come down. Profit after tax minus $500 million. Okay. Now this is why you must read annual reports. Okay, read it very carefully. Look at the percentages. When you are growing, when you are very happy, you proudly announce with percentages, 500% growth, my God. Then when you are on declining, no percentages, right? $500 million profit to $500 million loss. Okay. So this is finance. Okay. These are falling into financial intermediaries. And when it comes to listing, general public will know information. If this information is not available, how can you take decisions regarding deposits? Right. Once again, I'm asking you to read these annual reports, prepare, compare one with another, get updated. Okay, capital adequacy, what is our ratio? 8.5, 12.5, right? How are we maintaining that? Right. Now, when you are performing well, you are very proud to talk. When you are performing well, you show information which are not even required. When you are not performing well, you want to hide. You want to make all the mechanisms to hide that. Okay. Now, this must be your interested areas. Today, I'll take some time to talk about how things happen in well-developed nations. I have often talked about Ben Bernanke, the former chairman of Federal Reserves, and I have talked about a book written about him, right? And how he came to this position. We'll look at some of his now taxpayers' money for bailout. We talked about too big to fail. Means what? Certain institutions like Goldman Sachs Bank, too big. So you can't allow that to collapse. On such, you come up with bailout packages. What do you have to say?
Balance sheet. Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed, much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively, and we need to do that because our economy is very weak and inflation is very low. When the economy begins to recover, that'll be the time that we need to unwind those programs, raise interest rates, reduce the money supply, and make sure that we have a recovery that does not involve inflation.
He's not kidding about printing money.
Okay. See the way he answered, right? Now, I'm requesting you, when you have time to read, find this book and read it. When there are physical things available, say at IBSL physical library, you can borrow this. These days you are restricted even to move. right? So I don't know your ability to read such books, Courage to Act. Right. Okay. Then I would talk about that book. This book is autobiography about him. He was a university lecturer on economics. Once a team approached him and asked him, "Do you like to become economic advisor to US president?" And that's a political appointment, and that's a full-time job. Means you have to resign from your permanent lecturing post in university and join a political appointment. Means when the existing president moves out, you have to move out. And that's a full-time job, means you can't do anything else. He finally nodded yes. Now he became economic advisor to George W. Bush, and there were some other advisors as well. After some time, another team approached and said, the current Federal Reserve Chairman, Alan Greenspan, is in the last extension of his post as Federal Reserve's chairman. After him, right? So he has been for about 16 years and very old by that time, 16 years consecutively, the chairman of Federal Reserves. Are you going to take the responsibility of being the president of this institute? You are one of the earmarked person. He finally nodded. After that, there were discussions, and whenever Alan Greenspan talks about economics, he was there in the panel. And finally, out of this panel, Ben Bernanke was given the chance to further proceed to replace current Federal Reserve chairman. Means what, in Sri Lankan context, governor of central bank. Okay. There was an interview process. And finally, he was put to be interviewed by President of US, George W. Bush. George W. Bush interviewed him for about half a day. And after that, George W. Bush has given green light. Then Ben Bernanke thought, okay, now the process is over. That's how he writes in this book. After that, he was said, okay, now prepare for the final interview. He asked, who will interview me finally? The head of FBI. Means what? The economic head of the country is so powerful and so important, he cannot be someone with ultra motives like supporting to different political and terrorist movements. And now in this interview, he was asked whether you had any contacts with terrorist groups, either when you was an undergraduate or after that. He said no. So in this book, he says, even if I had any contact with terrorist movements, would I reveal it? Then somewhere he also says, means what? I have been earmarked for this position and was looked after by even FBI and other relevant authorities for a long period. That's how the post of Federal Reserve is filled. Then Janet Yellen, similar process. Okay. Think about Sri Lanka, how our finance ministers come up, how the governors of central bank. Okay. Now Alan Greenspan.
Maybe you can throw your 2 cents in and tell us what you think the Fed should do.
I tell the Fed in private what I think they ought to do, and that's the last I hear of it.
What about this notion of the economy weakening, potentially recession risks picking up? Alan, how do you see the U.S. outlook for the rest of the year?
Strangely enough, it's going to be...
Okay, so this was immediately after the situation when he was replaced by Ben Bernanke. Means what? There's a process to replace the existing, right? A succession plan. When we are talking about corporate governance, we talked about succession plan. When someone goes out, how do you groom the next layer? It cannot happen overnight. In Sri Lanka, think about how things are happening, right? How our finance ministers are selected, who are they, and how the governors of central banks selected. Look at the listed companies and compare their information. Okay, then look at our social media. What do they talk about? Okay, are they comparing numbers? Okay, this is input, this is how it is happening. Look at the forums that talk about Colombo Exchange. Now there are enough investors and they pump and dump shares. Are they talking in detail? Or they just say, okay, go and buy Bimput and it will reach 50, it will reach 70. Such company now trading at 6 rupees. Why can't they sustain their business? Why can't they remain as a stable finance company? Okay, who is running it? Now, these are the things you have to discuss, read about, and have a passion about. Okay, Alan Greenspan, then Ben Bernanke, next Janet Yellen. They were very passionate about what they were doing. Right? Ben Bernanke, the courage to act. Right? You can write your autobiography proudly. Okay? And when Ben Bernanke was an undergraduate, he even wrote to governors of certain countries to talk about their economic policies and how he felt. He said, okay, I never got the answer. But he had a passion even as a student, right? Not just to pass the exam, but to experience, to explore what is happening. Okay? Now, we are living in a country where there are a lot of areas to develop. Means what? Still you have enough potential. When you are young, from one side, now you have decided to do banking, you get a lot of information like this. Think about the subjects. They are perfectly designed. Right? There are no more traditional subjects like management. Okay, it's a good subject, but here we are preparing you future bankers. What you should know. Where do you find information? How do you compare that? Right? Think about the subject. Non-banking, how we talked about it. Okay? Then check that. All the relevant information. Search it yourself. Okay. Now I'm just showing you certain parts. I said, okay, this is what Colombo Stock Exchange is, right? This is our economy. These are good sides. These are bubbles. Okay. And I'm leaving you time to study them. I'm leaving you to get exposed. It's always better to know about these things than to wait until you reach this age. When you reach this age, you must have done your part and maybe harvesting what you have already done. Right. Now, we talked about capital adequacy. Capital adequacy means a bank and a finance company, when you are a financial intermediary, you have the privilege of doing business by collecting others' money in the mean of deposit. But this ability will enable you to misuse it. Why? You can run into extremely profitable, seems to be profitable, high-risky businesses. Once again, if time permit, we can see how the chairman's and the CEO's messages were seen in Bimput Lanka when they were performing extremely well, right? They were geared up. They were very happy with the way revenue is going up. They were very happy with the way profit is going up, 500% year-on-year basis, right? And what missed? Okay. Right. Then you can look at how the share price moved, maybe historically, right? What went to 50 came down to 60 for justifiable reasons.